Your income is taxed according to what is known as a sliding scale, where the first portion of your income is taxed at a lower rate and the next portion at a higher rate. As your income increases, it breaks into progressively higher rates until it reaches the highest one. From then on, any additional income is taxed at that highest rate. Let's say, for example, the lowest tax rate is 15%, the second is 20%, the third is 25%, then 30%, 35%, and the highest is 40%. Let's imagine that the tax brackets increase in increments of 100 Rand per year. The first 100 Rands worth of income would be taxed at 15%. In other words, Bob would pay 15 Rands worth of tax on the first 100 Rands worth of income in that year. If Bob earned a second 100 Rand in the same year, it would be taxed at 20%, and he would pay 20 Rands worth of tax on it. He will now have earned 200 Rand in total, and he will have paid 35 Rand in tax. He would pay 30 Rand in tax on the fourth 100 Rand, and on the fifth 100 Rand, the tax would be 35% or 35 Rand. By now, he will have earned 500 Rand in total, and he would have paid 125 Rand in tax. The last 100 Rand would have been taxed at 35%, but the first 100 Rand would still have been taxed at 15%. If Bob earns an additional 100 Rand, it would fall into the 40% tax bracket, and he would pay 40 Rand tax on that 100 Rand. Any additional income above that would also be taxed at 40%. So if he earned a total of 1,000 Rand in a year, the last 100 Rand would be taxed at 40%, while the first 100 Rand would be taxed at 15%. In other words, if Bob earned 1,000 Rand in that tax year, he would pay a total of 325 Rand in tax. The 325 Rand in tax represents 32.5% of the 1,000 Rand that Bob earned. So although his current tax rate is 40%, because the first portion of his income was taxed at a lower rate, it means that he paid an average of 32.5%. The 40% in this example is what's called his marginal rate, and the 32.5% is called his average rate.